Saw yesterday with that 5.5% cut, but I would say it's still very tentative. We started off with a move of about 1.5%, got sold into that. We're up about 0.5%, and now again making a comeback, holding up 80 points up in the green for the Nifty futures, just cutting around that 93.60 odd level in trade. The breath as well has come off a wee bit from the top, but it's okay. We're good 100 stocks standing to the advances with some of the oil and gas majors, SBI Life, ONGC, Infratel. These are all names which are holding out. From within the Nifty, it's M&M as well as Z and Bharti and Reliance, which are also really leading today's move. But let's welcome on board a very special guest. We've got on board with us Renuka Ramnath, founder, MD and CEO at Multiples Alternate Asset Management. Renuka, morning. Good to have you on the show. Thanks so much for joining in today. How has your environment been impacted? The VC and the PE community. Do you see also a significant drop in sales because of COVID-induced slowdown? Or do you think these are days when you find and spring up better opportunities within that particular genre?
Ajay, I would say it's a very tough time because when we are investing, we invest behind a very prosperous future that we are able to imagine for the opportunity that we are investing in. Today, because of this unprecedented health crisis that we are going through, and confusion around what is going to be the social behavior going forward, confusion around availability of finances in the system, also huge limitations in terms of ability to determine the damage that it has done to various enterprises in financial terms, we will be crusading through an extremely difficult time for making investments. So while there is an opportunity set out there, the opportunity set is there because more than at any other time, entrepreneurs will need capital now. Two, they will be much more risk averse in terms of funding their businesses with debt than they would have been in the past, because the whole pain of trying to build a business on the back of debt is something that would have come to reality for most people. Third, most entrepreneurs will be far more balanced to slightly, I would say muted in terms of their future expectations of how their business will perform. So they would want to be well funded by way of equity. So from a demand side of equity, it will be a very good environment, combined with the fact that valuations have got corrected because of the current situation, which doesn't necessarily mean that the future is not as bright as it was in the pre-COVID scenario, makes it for a very interesting investing environment. But the uncertainty about the current situation, the uncertainty about how long it would take for the turnaround, the uncertainty around how the economy is going to revive as a whole, will make our jobs.
But you work closely, Renuka, with a host of companies across various sectors. How are you observing the economic slowdown for the business community? How is it that you see them start coming out of the lockdown gradually and then finally picking up the pieces?
So the extent to which companies have hit is pretty much a function of in which industry you are operating. So if you are in the retail industry where, all malls are shut, as you know, all shops are shut, even when they open, they're going to open gradually. Even if they open gradually, people may not come back, in the same strength as it was before COVID. The retail industry, which depends on footfall, is very, very deeply hurt. And we are planning that it would take end-to-end at least a period of 9 months for it to come back to probably 75-80% of its best performing days. And then it will take longer for it to go back to a higher base than what it left before COVID. Then you have financial services industry, which is again a very, very big industry, very big opportunity for private equity players. Approximately 50% of the capital every year gets invested in financial services industry. Here again, if you look at lending industry, that is affected very differently. Within lending, when we look at microfinance, we are unable to even determine how deep the impact is going to be and how long. Whether any of the current outstanding loans would be recovered or not. Some of the big franchises may still be able to recover because of their deep presence and deep understanding. Some of the younger franchises this might probably be the first crisis that they will be going through and learning their lessons and preparing for the future. If you look at micro enterprises, small enterprises, the pain is going to be very long because even if the front end business is open, the first job will be one of clearing out the inventory. So, these guys who are at the back end supplying to the front end might take much longer to recover. Then when you look at small enterprises like all the retail, small offerings, the lost revenue is lost revenue. They're all sitting either on rented property, borrowed equipments, fixed costs of, some salaried worker, while they will have a significant portion of variable costs. These people are going to take much longer again to recover, and their wherewithal to bear the losses and the interest on their borrowing is very, very limited. So companies, NBFCs, which were focused on this segment, probably will see more pain when we come out of the moratorium. When you then go to non-lending businesses like insurance, the worry is that, whether people are going to have enough money in their wallet to want to buy insurance products. In life insurance, most of the products are savings products. Again, the consumer behavior and the availability of capital for these products will be limited. So across the spectrum, you are at the very minimum going to see much more muted growth rates. And for some companies, you're also going to see a much more spiked delinquencies in their portfolio.
So, Ms. Ramnath, what are your views on the policymakers' action and the policy action which has been taken so far? And if you compare that with other economies, where do we stand?
See, there has pretty much been no stimulus for corporate India, right? I mean, whatever has been done is for the bottom of the pyramid, much more to take care of the fact that we don't want anyone to go hungry. That's an extremely important first step. And that has to be probably sustained over longer periods of time. But as far as corporate India is concerned, the only action that has been done so far is pushing liquidity by Reserve Bank of India, making a severe disincentive for banks to either put the money back with RBI or not do anything. But even there, we have had extremely limited success. As all of us knew, the first TLTRO was taken up for very, very robust companies, AAA plus kind of companies. The NBFC-led TLTRO was not a success. So although the attempt has been honest, the attempt has been substantive by Reserve Bank of India, the percolation has not been anywhere near what we desire. But the whole of corporate India is waiting for an economic stimulus, across the board for this unprecedented crisis that we have gone through. In a way, I would say that we need a stimulus which will literally suck this problem out. If not 100%, at least 60, 70%. And the 30% problem can linger for a period of time and companies will come out of it. But if we just allow this to fester, then the road to recovery will be too long. And, it would have huge cascading negative effect on the economy for a very, very long period of time.
So how are you challenging with your portfolio companies? For example, you've got investments in Dream 11, PVR, even Arvind, part of Arvind Fashions. At a time when liquidity is dry and generally there is a slowdown in some of the discretionary spend, how are you dealing with this?
Yeah. So I would say that companies which are invested by classical VCPE funds will have tremendous backing from their investors. So that's all we all do. Talk to our companies and see from where we can raise debt for them, from where we can, raise more equity for them, including we supporting our own companies with equity. So I would say that it's not easy, but at least they have a very, very strong financial partner who will help them navigate this very difficult situation by bringing in their own connections, their own pools of capital, their own limited partners' desire to keep the companies going through these troubled times. So we are looking at all sorts of capital. We are also talking to the government to give us flexibility in terms of under what financial instruments would we bring this capital to our company. As we speak, there are a lot of limitations because much of our regulations are framed for good times, where you are looking at how do I protect the interests of minority shareholders, how do I make sure that there is no indiscriminate flow of foreign capital in instruments that corporate India cannot sustain, how do I make sure that there are no different classes of investors in the same company so that again, interests of minority shareholders are not protected, or how do I make sure that in publicly listed companies, the promoters are not taking undue advantage to the detriment of minority shareholders. So the consideration set for how regulations have been formed in another time was very, very different. Whereas today it is a question of, can I find the capital and keep these companies going? Can they get enough capital maybe to consolidate the industry? There will be a lot of consolidation opportunity that is available. There will be opportunity to hire very good talent and invest for the future. But this money is not going to come on the same terms that we were investing in prior to the crisis, which was much more a business as usual case. So we are also as an industry talking to the government and saying we need a comprehensive relook on under what instruments can private capital come into corporate India. So I would say that companies which have been funded by this community of investors and other investors as well who have deep pockets, who have long-term view, who have had the experience of going through these kind of crises in the past are in a slightly privileged place relative to companies who don't have an equal financial support. But irrespective, I think we need to solve for availability of both debt and equity, which is predicated on a very good economic stimulus for corporate India.
Renuka, how much dry powder do you see sitting on the sidelines right now? I mean, if we take a look, I think EY is seeing 40 to 50 billion worth of dry powder that's sitting on the sidelines looking for opportunities. What, according to you, could they possibly be eyeing here in India? What are the prospects looking like?
It is the fact that, the estimates vary from 25 to $35 billion of dry powder for India alone, right? These are funds that have been dedicated or raised with a significant possible commitment to India. I would say that I would be surprised if any transaction happens in the next 6 months because everyone would want to know a near reliable balance sheet that they are investing in. And I do not know how we can assess that. In certain sectors which are less affected, let's say pharmaceutical sector, IT services sector, these are far less affected by the current, pandemic. In the IT and IT-related sector, at least we do not have issues of huge supply chain, and we don't know whether our, inventory is, realizable. We don't have issues like in a fashion industry and so on. So these kind of sectors will get ready to absorb third-party capital fairly quickly. Whereas certain other sectors, investors would want to wait and watch in terms of what is the revival plan and what's the revival scenario before they are able to make the commitment. Again, as I said earlier, it is important that we have some flexibility in the manner in which we bring this capital into these companies. If it has to be just straight equity, where you take all the risks like an incumbent shareholder, the total deployment will get limited because there will be very few opportunities where we can develop that kind of comfort. But if we are able to come in as a rescue capital, have privileged terms, or if we are able to have some combination of debt and equity, again on privileged terms, establish a slightly superior position to the incumbent liability providers, or construct interesting upsides around stitching warrants along with equity or along with convertible debt into these companies, or we are able to bring banks along with us so that we kind of fully capitalize these companies with appropriate debt and equity structures, then the flow of capital will be quite rapid. But I must say, honestly, at this point, the rest of the participants in the financial system are still grappling with the problems of the past. And there is limited bandwidth or interest in knowing how do we bring this $25 to $50 billion into the industry, which is just waiting there. It's at the door and wants to be invited, but some accommodation has to be made in terms of making it attractive for them.
So you did mention some, but if we were to just take a closer look at the sectors perhaps that are likely to still come out of this relatively better than some of the others, if we were to pinpoint some of those, what would they be?
Again, I would say that, sectors which are where even financial services, right? I mean, in the lending business, until things open up and we see, what is the kind of collections that have been possible, how deeply are these borrowers impacted, it will be difficult for us to make an assessment of what is the balance sheet we are investing in. But definitely sectors like logistics, IT, everything around IT, whether it is services or more cutting-edge AI/ML companies, the disruption. There is disruption across the board. There is no running away from that. But they can fix these disruptions, and you can also put your arm around what's the balance sheet you are investing in. But retail companies, lending companies, especially to the smaller businesses who are a lot more dependent on here and now cash flows to repay, fintech companies, those would be a lot more difficult. I won't say carte blanche that something is impossible, but I would just at a high level say that these companies where there is a supply chain effect, where there is a huge balance sheet effect, where there is an effect coming from near-term cash flows deeply affecting the performance of these companies, will be very difficult to enter. Whereas if you look at pharma companies where, especially in the therapeutic area, whether there is lockdown or no lockdown, everybody has to take those medicines. So they are less likely to be affected. As I said, everyone will be affected, but they can get up and run much, much faster. Logistics companies, ITES companies, maybe even insurance companies. We may moderate the growth rate in the near terms, but it is possible to invest in those companies because the balance sheet disruptions will be very measurable. In those kind of companies.
Renuka, thank you so much for joining us today. Always a pleasure and great to hear from you on how things are likely to look, post-COVID. Let's take a very quick break on that note. Back in just a moment.